and thank you very much for that introduction. But before I talk specifically about the trust, I'd just like to touch on Troy Asset Management, which is the management company that manages the trust. It was founded at the turn of the millennium by Arnold Weinstock, who was for many years the chief executive of GEC, one of the UK's biggest and best known industrials. And it was founded by him and Sebastian Lyon, who remains our chief executive and founder, with an aim of protecting investors' irreplaceable capital, whilst, as the quote says there on the page, whilst increasing its value year on year. And this defines almost in every way how we think about investing, how we think about risk, how we manage long-term, and how we manage the long-term savings vehicles that we look after, like the Troy Income and Growth Trust, which this presentation talks about. And that idea, that philosophy permeates everything we do, as I said, and this slide just tries to explain how that starting point integrates into our investment process. And it is that investment process that is central to what we do and underpins the performance that the trust can generate, as Ryan alluded to earlier. We have a very strong focus on delivering high quality or investing in high quality companies. We want companies that are well managed, that have strong business models, and companies that are robustly financed with strong balance sheets. And this slide tries to explain a little bit about why that is so important. What we mean by strong business models is companies that have barriers to entry that prevent competition from taking market share from them, that allow them to steadily grow their revenues. It provides them with resilience against technological change or disintermediation, and in addition to that resilience against change in their industries, it provides them with a certain amount of insulation from the economic cycle. And these factors combined enable companies to operate profitably and to add economic value. And that's what we mean by a return on capital greater than the cost of capital. It means these companies are making money and they are growing in each year the amount of money they make. And what that provides is this idea of growing free cash flow. And this is really central to what we do. We're looking for companies that are generating excess cash, and the amount of excess cash that they're generating is growing. And what that allows companies to do is to either return cash to shareholders in the form of a dividend, and that's important for what is an income and growth trust. It allows them to pay down debt or accumulate cash, and that's important for making acquisitions, having a strong balance sheet, having dry powder, and having something stored away for a rainy day when markets are more difficult and more challenging, or when opportunities present themselves. And it also allows them to reinvest in their business, adapt to the way the market and their industries change, to stay relevant and to invest in future growth. And at the bottom of the page, we just talk a little bit about Croda, which I think is a really good example. It's a stock that we bought for the portfolio it's halfway through last year. It's a specialty chemicals company based with a bias of producing chemical components from natural feedstocks rather than from petrochemicals. It creates the active ingredients in things like anti-aging creams, sunscreen, and it also has a life sciences business which creates components for vaccines, which is obviously highly topical at the moment. And the data relating to Croda and the sort of key touch points that I think really interest us about a stock like this is, you can see at the bottom of this page, our revenue growth of just under 8% on average over the last 20 years, a return on invested capital in excess of 18%, which is double that cost of capital, so a highly profitable company. And that underpins a free cash flow growth of 10% per annum, which feeds the dividend growth and allows them to make acquisitions, allows them to grow the business, and allows them to add businesses into their mix and expand what they offer by buying companies like Iberchem and Avanti. And interesting, I'll just highlight Iberchem here, which is a natural fragrances company. It allows them to put natural ingredients into things like shampoos and sunscreens rather than petrochemical derived flavors and fragrances. And that's particularly important at the moment when there is a really strong focus on sustainability in terms of the way companies operate and their products. And this is another leg of, I suppose, the way we invest, looking at this sustainability and trying to make sure that the companies in which we invest are sustainable for the long term. If you're going to be a long-term investor and you're going to think about holding a company for 5 to 10 years in your portfolio, you really need to understand both the environmental, social, and governance risks, which is what that ESG mnemonic at the top stands for, as well as the financial risks and opportunities. Because it's only by understanding the company in a whole and really doing that in-depth research that other speakers have spoken about today, really getting to know your companies, that you can protect yourself against waking up one morning and finding out that a problem in the supply chain or environmental mismanagement has deeply compromised your brand or the balance sheet of the company and left investors sitting on a capital loss. And we're really keen to avoid that. And so this focus on sustainability is a really important aspect of what we do. By way of demonstration, we sold our holding in Coca-Cola last year. This is a company that ticks a lot of our boxes, but when we engaged with them and spoke to them about plastic pollution, Coca-Cola being one of the top 3 generators of branded plastic found polluting our oceans and beaches, etc. We found that their response was just inadequate and that they weren't addressing the issue with the kind of serious and diligence that we would have hoped for from a company of that scale. And we felt that along with deteriorating financial metrics, that this was not a company we wanted to continue to be invested in. Companies like Unilever, etc., do this much better and are really interested in the long-term sustainability of their brands. Lastly, on this slide, we're not just preaching to our companies about this. Troy's taking active steps as well. You can see the Flora and Fauna International logo on the left-hand side there. The reason we put that there is because at the moment we're engaged in developing an industry standard with Flora and Fauna that will provide a British standard, an international standard as well, potentially in the future, around the way industries handle plastics in the production process. And we think that will help address this issue of plastic pollution. So we're doing this through multiple avenues to try and ensure that we are both having a positive impact, but as well protecting investors from some of the downside that these issues can cause within their portfolios. What this distinctive investment style means is that we end up with portfolios that look very different from the market. And by way of sort of trying to summarize this slide just shows where we most often find the sorts of companies we want to invest in and where we least frequently find those types of companies. And in that persistent opportunities column, we find companies that we think can compound returns steadily year over year without interruption, that can generate those sort of steady returns that we want to deliver from this trust. In the select opportunities, there are much greater differences between the good companies in those sectors and the less good companies in those sectors. And a company like Croda, which is a specialty chemical company that I've spoken about, is an excellent example of a really fine company in the select opportunity sectors. But the bulk chemicals companies are companies that we'd be much less inclined to invest in. And then the infrequent opportunities are sectors where we really find it very difficult to find these steadily compounding, sustainable, stable type of companies that we're looking for. It's not to say that these companies can't generate very strong returns over short periods of time, but these are not the sort of companies that you can put in your portfolio and reliably look forward that they will compound year in, year out. And the airlines are a very good example of this. IAG or British Airways as it is today, or British Airways as it was, is both a capital intensive and cyclical stock. It's doubled since November, since the announcement of the vaccine, and has delivered a fantastic performance for investors. But when you look at it over a longer time period, it's still down 50% from its January highs. And we just don't feel the need to subject investors in this portfolio to that level of volatility and to that level of risk. And so we'd much rather invest in the steadier compounders. What this means is that having a different portfolio also generates very different returns from the market as a whole. and we need to be aware of how those returns differ. You can see that the fund has delivered, trust has delivered 200% or more since we first started managing it, versus 150 or so from the benchmark. You can see that that's being done with lower annualized volatility, lower risk at the bottom of that table. And this is ideally what we're trying to deliver. We've done that without gearing the trust, and we also have a discount control mechanism, which means that the value of the underlying shares is reflected in the share price of the trust. And all this removes risks for investors while hopefully still giving them access to the returns that we're trying to deliver from the trust underneath. This is a slightly different version of the same slide that Ryan showed you, it provides a little bit more detail on that performance. You can see the years where we performed better in 2011, 2014 and 15 and 2018, but also the years that Ryan highlighted earlier, like 2017, 2012 and 2013, where performance was lagging the broader market. One thing I would point out in addition to what Ryan mentioned is that in those 3 years that he picked out, 2012, 13 and 17, the trust delivered absolute returns, although it was behind on a relative basis, absolute returns of 9%, 17% and 8%. Those are very good returns in our minds in any 1 year. And so although we may not keep up with the market in years where it's particularly ebullient, where people are particularly excited about the amount of risk they're willing to take, we will continue to deliver, hopefully, a steady absolute return. And you can see in the most recent year to date that we're going through a period, a similar period at the moment. As we had the vaccine announcement, you can see that the markets have been much more risk on. You can see that red index line start to tick up. And when people get much more excited about the market, and you see people moving away from the steady compounders into some of those stocks like airlines that they think are going to see a bit of a pop, we are less likely to participate in that sort of market. And you can see that playing out in this year to date. I'll talk a little bit more about that in due course. But that's not all a disadvantage to us. The dislocation over 2020 and what we've seen so far this year also provides us with opportunities. It provides us with an opportunity to add interesting new ideas to the portfolio. We've added stocks like Visa, Croda, as I mentioned, and Intercontinental Hotels Group to the portfolio. All of these driving a better growth profile for the portfolio. It's also given us the opportunity to add core holdings, or add to our core holdings in that consumer staples area. Stocks like Diageo, Unilever, Reckitt Benckiser. And these are the sorts of companies that can really deliver the robust level of compounding that we're looking for. And so all in all, having come through this crisis, the pandemic, we feel that we've been able to use that opportunity to put together a portfolio that really has excellent prospects in terms of free cash flow generation, long-term dividend growth, and clearly that will translate into capital growth as well, we hope, for investors. Before I sum up, this is just the sort of final slide on why to invest, or why we should be considering this portfolio today and this trust today. Ryan spoke about trusts and investment portfolios falling out of favor and being in favor at certain points in the market. And clearly, from what I've been saying over the last few minutes, the sort of environment that we find ourselves on as investors are willing to take much more risk and are willing to move away from the steady, reliable compounders, the high quality companies, and favor much more speculative investments, much more highly levered investment, much more value orientated investments, is not our sort of market. But we've been through these environments beforehand, and this slide just tries to illustrate some of that. You can see when our top 10 holdings fall out of favor, the free cash flow yield, as shown on the blue line of those portfolio holdings, starts to rise. And when we get to a free cash flow yield, or it has been the case over the last 5 years, of around about 5%, we believe that those top 10 holdings, which comprise over between 40 and 50% of the portfolio, are really offering interesting value and offering good future returns from that level. And on the red line, you can see over those similar periods following those 5% free cash flow yield peaks, you can see the periods of very strong performance that have come as a result of that. And you can see on the far right hand side that we've nudged up to that 5% free cash flow yield today. And as a result, we feel comfortable and confident about the value that the portfolio can deliver from this stage. So just by way of summary, with Brexit largely behind us and the risk from the pandemic receding, and the high quality that we've been able to embed in the portfolio is also something that we're really excited about. The opportunity that we've had over the last 12 months to really deliver a portfolio that can underpin growing dividend growth and a stream of increasing cash flow to our investors. And with that, I'll say thank you and hand you back to Roland, and thank you for listening.